Say you have money. Maybe it's not enough for a house, but it's definitely a respectable amount. You could have it sitting in your bank account, but you've probably heard that because of inflation, it's actually losing you money. So you're thinking of investing. But isn't investing just for rich people who can afford to gamble on the market? Not at all. Welcome to Allie Invests, where we teach you how to future-proof your finances while living your best life. Don't forget to hit like and subscribe for more content. Today, we're tackling a topic that is incredibly important to building wealth: starting to invest. With just $100, you can plant the seeds for your financial growth and begin a journey that could transform your financial landscape. From choosing the right platform that aligns with your financial goals, to understanding the various investment options available to you, we'll guide you through every step of the process. We'll also share some key strategies to help you make the most of your initial investment, highlighting the importance of starting early and the magic of compound interest. Whether you're a college student, a young professional, or someone simply looking to make their money work harder, this video is your starting line. So, grab a notebook, take that first step towards financial empowerment, and let's dive into the world of investing together. Why $100 is enough to start. First, you need to understand compound interest. The power of compound interest cannot be overstated. Even with an initial investment of $100, compound interest allows your money to grow over time, earning interest on not just your original amount, but also the accumulated interest from previous periods. This exponential growth means that your $100 investment has the potential to grow significantly over the years, making it a worthy start. Second, investing today is more accessible than ever. With the advent of user-friendly investment platforms and apps, starting with as little as $100 is now a possibility for anyone. These digital tools offer simplified interfaces and educational resources, empowering beginners to make informed decisions. Additionally, innovations like robo-advisors and the option to purchase fractional shares have lowered the traditional barriers to entry. This democratization of investing ensures that wealth-building opportunities are within reach for a broader audience, regardless of their starting capital. Next, you need to choose the right investment platform. Choosing the right investment platform is a critical step in your journey to financial growth, especially when starting with a modest amount like $100. The market offers a variety of platforms tailored to beginner advisors, including robo-advisors, investment apps, and online brokers, each designed to accommodate low initial investment. When selecting a platform, consider 3 key features. Low fees. Look for platforms with minimal fees to ensure that your investment isn't eroded by high costs. Many robo-advisors and apps offer low or no transaction fees for basic investing, which is ideal for those starting small. Ease of use. The user interface should be intuitive and straightforward, allowing you to manage your investments without confusion. A platform that facilitates easy navigation and transaction execution will make your investment experience more pleasant and efficient. Educational resources. For beginners, access to educational materials is invaluable. Platforms that provide tutorials, articles, webinars, and even one-on-one coaching can significantly enhance your understanding of investing and help you make more informed decisions. By prioritizing these features, you can select an investment platform that not only allows you to start with $100, but also supports your growth as an investor. This careful selection ensures that you're equipped with the tools and knowledge to expand your portfolio strategically over time. Next, understanding your investment options. Investing in stocks is a classic path to wealth building, and fractional shares now make it accessible with minimal capital. Instead of buying a whole share, you can invest in a portion of a stock from leading companies, allowing you to participate in the stock market with just $100. Index funds are mutual funds that track a specific market index, offering diversification and lower risk. Many index funds have low entry requirements, making them an attractive option for beginners with limited funds. They provide exposure to a broad segment of the market at a fraction of the cost. Bonds are loans that you give to the government or corporations in return for periodic interest payments, plus the initial investment back at maturity. Investing in bond funds allows you to lend to multiple entities, spreading the risk. With $100, you can start investing in bond funds focused on government or corporate debts. ETFs, or exchange-traded funds, are similar to mutual funds, but are traded on stock exchanges. They offer diversification across various assets and have lower expense ratios. With $100, you can invest in ETFs that cover sectors from technology to healthcare, providing a balanced investment portfolio. For those interested in more speculative investments, cryptocurrencies offer an entry into digital assets. With $100, you can invest in various cryptocurrencies, taking advantage of the potential high returns. However, it's crucial to understand the volatility and risks associated with this investment type. Each of these investment vehicles offers a pathway to grow your initial $100 investment, provided that you take the time to understand their nuances and align them with your investment strategy. Then, making your first investment. Making your first investment is a significant step towards financial growth, but it requires careful planning and research. Before allocating your $100, it's essential to understand the investment landscape and how different options align with your financial goals and risk tolerance. Prior to investing, dedicate time to research. Understand the fundamentals of each investment vehicle, from stocks and bonds to ETFs and cryptocurrencies. Evaluate their historical performance, risk factors, and how they've reacted to market changes. This knowledge base will help inform your decisions, helping you select investments that suit your long-term objectives. When deciding how to distribute your $100, consider a mix that reflects your risk tolerance and financial goals. For a more conservative approach, you might lean towards bond funds or index funds, which generally offer steadier, albeit potentially lower, returns. If you're willing to embrace more risk for the chance of higher returns, allocating a portion to stocks or cryptocurrencies might align with your strategy. Remember, even with $100, spreading your investment across different vehicles can mitigate risk. Diversification is key to reducing risk in your investment portfolio. It involves spreading your investments across various asset classes to minimize the impact of poor performance in any single investment. Even with a modest sum like $100, you can achieve diversification by investing in ETFs, which contain a basket of stocks or bonds, or by splitting your investment among different sectors or asset types. Diversification can protect your investment from volatility and improve the likelihood of a stable return. In summary, making your first investment with $100 is an exciting venture that lays the groundwork for future financial success. By conducting thorough research, carefully allocating your funds based on your personal risk tolerance and goals, and emphasizing diversification, you set a strong foundation for your investment journey. Some tips for successful investing. One of the most effective strategies is to invest consistently. Consider setting up automatic contributions to your investment account. Even small, regular investments can accumulate and benefit from compound interest over time, turning modest sums into substantial wealth. This approach also helps in averaging out the purchase price of investments over time, a strategy known as dollar cost averaging. 2. Avoiding common pitfalls. Many beginners fall into the trap of trying to time the market or impulsively following the latest investment trends without adequate research. Another common mistake is allowing emotions to dictate investment decisions, such as panic selling during downturns or buying into a hot tip without analysis. Successful investing requires a disciplined approach, focusing on data-driven decisions and long-term potential rather than short-term fluctuations. 3. Patience and long-term thinking. Patience is a virtue, particularly in investing. It's important to understand that building wealth is a marathon, not a sprint. Market volatility is normal, and while investments can fluctuate in value in the short term, they tend to increase in value over the long term. Adopting a long-term perspective helps investors ride out market lows and benefit from the highs, ultimately leading to growth in their investment portfolio. By embracing consistent investing, avoiding common pitfalls, and maintaining patience with a focus on long-term objectives, investors can navigate the complexities of the financial markets more effectively. These principles not only help in mitigating risks, but also in capitalizing on opportunities, paving the way for a successful investment journey. Thanks for watching, and make sure to follow Hallie Invests for more content like this. See you next time.